Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly Australian economy and housing update with our friend Martin North from Digital Finance Analytics. How are you, Martin?
Very good. It's crazy out here.
Even
Crazy,
just the
crazy.
past 24 hours has been pretty crazy. And I know you're in high demand. It was good to see you on mainstream TV on the project last night, and you're still making time for the little people at Nuggets News, so I appreciate that.
Ah, from sublime to ridiculous.
You've got 19 slides for us today, so I'm pretty excited. Do you want to talk about anything in general before we dive into it?
I just want to highlight we're at a potential inflection point, right? All the focus has been on inflation and trying to conquer inflation, which means putting rates up. We're starting now to see the cracks beginning to show, and the data that we'll discuss is highlighting that now the Fed has got itself into a really difficult position because now the US economy is a bit wobbly. We know that our economy is wobbly. And so the question is, do they go on putting rates up? Do they stop? Do they try and turn around and throw more liquidity into the market? Are they going to have to put more fuel on the fire, as it were? Things are very, very chaotic.
Yeah, and the forces in play are they supply chain structural issues that are causing a lot of the prices to go up for consumers? Is it the fact that we did all these stimulus injections directly to consumers' accounts, which hasn't really been seen before? And have they, as you say, taken their eyes off the economy because of just that inflation number? And we always talk about the bond markets and how they're forward looking, and I think they've priced a lot of the stuff in already. And right when the Fed's going really aggressive, and as we saw yesterday, they're in a recession, but they're changed the definition of recession. But if you say that on Twitter at the moment, it's blocking you and telling you that's disinformation, that they haven't changed the definition of a recession.
No, well, there are a number of different definitions of a recession, right? So, two negative quarters is what some people think. But there is actually, of course, in the US, there's a committee that actually will look at the data and then later will determine whether or not there is a recession. So the question is, are we or aren't we?
Yeah, okay. Let's dive into it all. So, first up here, as you say, the I guess commonly accepted, or what has always been known as a recession, is two negative quarters, and we've just had that.
Well, that's right. So this is an annualized negative quarterly result. I mean, they calculate it really weird to start with, but clearly something has happened. If you go back a year, significant growth. Now we've had 2 quarters of negative growth based on some set of data. Now, this is preliminary data. It's worth just making the point. This may change, right? Because this is the first outing, as it were. So, but this is consistent with what the Atlanta Fed was saying with their now GDP cast, right? So it looks as though the US economy may be a little bit weak. And the reason is that real retail sales is very weak. And that's a big deal because consumers are such a big part of it.
Yeah, and as you say, that number can get revised later on, but it's pretty rare that we see it get revised more than zero point 0.1 or zero point 0.2. It's not like it's going to just we missed the mark by 1%, and hey, we're not in a recession. Who knows what they pull out of the hat? But it's very unlikely that that number is going to change into a positive.
And everybody, from Biden down in the US was very pains to point out, well, there are very strong signs, labor growth is very strong and unemployment's very low, et cetera, et cetera. So we're actually well positioned. So we're not really in a recession. Indeed, Powell said that in the press conference yesterday. So, whether you go with that specific definition or whether you look more broadly, I guess is a matter of opinion. But what you can say is that relative to previously, the US economy is slowing and it's slowing fast.
And we saw similar in Australia this week as well with their retail sales numbers negative.
Absolutely right. And we might touch some of those other local numbers as we go through the conversation.
Yeah, beautiful. So the recession signal here, the bond market, which I love, we've got the yield inversion between the 2 and the 10, and something that was pretty surprising was even after the Fed jack rates, the yields fell even more. And to me, for people at home, what that's kind of saying is, well, the more aggressive you go now, Fed, the more severe you're going to make the recession later on. So we don't see that very often at all.
No, this is significant. Now, again, let me make the point that, of course, the Federal Reserve actually came out with a paper some time ago saying that this signal of 10-2 reversion doesn't tell you anything. In fact, look at other things, right? Funnily, they sort of almost sound a bit reinventing history here because actually, if you look at it consistently, you'll see that actually this recession signal is pretty strong, it's consistent, and now we're seeing the same again. So this is definitely a potential signal of slowing later whether it's a recession or not, it's definitely slowing. And as you say, the 10-year dropped significantly, 2-year dropped a little bit as well, but still that inversion exists. And it's been now around for 2 or 3 weeks. So this is now a significant signal in my view.
Yes. So this leads to the US dollar getting stronger. We've spoken about this in previous episodes. People can get higher interest rates on the world reserve currency, which they think is the safest or cleanest dirty shirt in the laundry, but it hit 108, come off a little bit since.
Yeah, and it's just worth reflecting. 40% of international trade is in US dollars. And the impact of US dollars is having a huge negative impact on emerging economies, from Sri Lanka and others as well. And the dominance of the dollar, when you've got a weak China, is very significant, because you could argue that the reaction of this dollar number is simply because of the very high interest rates now coming through in the US. And so there's really not a chance in the short term of this suddenly reversing. And if you go back to the 80s, they actually ultimately had to have an agreement to take the dollar weaker, because they were then even stronger relative to the other currencies, and they were absolutely grinding other countries into the ground. So we're in a bit of that same thing again. Very strong dollar might be okay for the US, but it's pretty bad for everybody else.
Yeah, and there's been some theories going around about Bretton Woods or a Bretton Woods 2 style agreement if things get too out of hand. And it's probably not that level just yet, but if the dollar keeps going higher and they're not able to get these things under control, I mean, I've got a few theories about things the Fed could possibly do. We might talk about in future, but I think in some of your other slides here, you've got some of the other countries and what they're doing with interest rates and so on. But one thing I did read in the news that's resurfaced, that again, it's been around a while, simmering in the background, but this talk about the BRICS nations, particularly Russia and China, getting together and doing a commodity-backed currency of some style. I think that's very difficult to execute in reality, to prove resources and whatnot. But I think it's just that sentiment that they're pushing, that, hey, we've got commodities and real things that we want to back our currency with. And a lot of countries don't want to just keep being pushed around by the US necessarily, that has all this hegemony just from the privilege.
No, that's right. And China and Russia are talking about gold-based, and so there are some alternative things being floated at the moment. None of them have sufficient momentum to knock the US dollar off its prominent position. Of course, with uncertainty around the world, more people then say, well, actually, the US dollar is the best bet in the worst field, right? So that's the problem.
Yes. Okay. Next up, the inflation and the changes from month to month.
Yeah, so this is really important. This is the latest IMF report. And basically, they're saying inflation globally is much worse, much higher, and it's going on for longer. And that's true both in advanced economies and in emerging markets. And remember, these are based on the official figures, right? So the real inflation, as we said before, is much, much higher. So the idea of this as being transitory and it's going away anytime soon is completely untrue. And in fact, they said that there is a global downturn now in economics, pretty much wherever you look, and it's going to get worse.
Yeah, and same story in Australia, where I think they're just saying now even 7.5 was the last figure I've seen that they're projecting for inflation to peak out, whereas 6 or 12 months ago they're saying we're not going to raise rates for 2 years. So yeah.
Well, so they're saying it could be as high as 7.73,
yeah,
right? And then going down over 2 or 3 years, and they're also down forecasting growth in Australia, and also the wages growth is significantly lower. So it's not, you're not going to get real wages growth in Australia according to the latest Treasury modelling for at least 2 or 3 years. So we're going to go backwards, and when they're going backwards. That's true in a lot of other countries too, because we've got stronger inflation relative to wages, overall growth now easing. So those fundamental economic forces are all pulling in the wrong direction. And yet, to go on to the next slide, what are French central banks doing? They're just driving rates higher. There's a synchronized tightening going on. And if you think about just how remarkable this is, if you go back to 2020, they were all sort of driving the other way. Right? That was obviously in reaction to COVID. Now everybody's lifting rates. ECB's lifted rates, and other people too. And of course, the Fed did their 75 basis points. And the question is, how much more will they do? What is the right trajectory here? The expectation is that next week we're going to see another rate rise in Australia. And of course, ANZ in Australia is suggesting the Reserve Bank could take rates to 3.35% by the end of the year, which will be 2% higher from where they are.
What do you think about that, Martin? Have you got a base case of maybe Australia or the US?
Well, look, I think that we are now getting to that potential tipping point when suddenly people say, oh, hang on, what's going on here, right? Because we know that households are really going to be under the gun. We'll come to that in a second, right? And we know that the rising interest rates are beginning to dent the financial markets. And again, we'll touch on that a bit later. So at some point, they will slow. And in fact, the Fed did say, well, we will start looking at the data, whereas they're just driving very hard at the moment. So I think there'll be a slowing, but there is a very strong doctrinal position that you got to kill off inflation, because if you don't kill off inflation, everything else goes to water as well. And there's a big debate, of course, which is better, right? Lower inflation and higher unemployment, or is it better to have a bit higher inflation and lower unemployment? That's actually the linchpin of the discussion now. And there are people saying, well, maybe we should have a higher inflation given everything that's going on and given the supply chain disruptions, et cetera, et cetera. So maybe we're trying to sort of thread the eye of the needle when that is unnecessary to do. But at the moment, everybody's saying, no, we have to actually deal with inflation, which stubbornly means putting rates higher.
Yeah, I tend to think we might get one or two more over the next 1, 2, 3 months, but I think that by the end of the year, we could even see cuts as well. So that's
I think cuts sooner than you expect. Yeah, I tend to agree. I've said for some time, I think September will be the peak, and then we'll start seeing some easing later in the year. Might go sideways for a little bit and then down. So, ANZ, as I say, is the most bullish. But the other big three banks, well, the other three of the big four, have actually pretty much said, yeah, the rates are going higher as well. So, in Australia, the traditional doctrine is rates are going up.
Okay. As you just mentioned before, the ECB have finally joined that hiking club as well.
Yeah, except of course China. China is the big standout, right? China is actually going the other way because they've got big issues. They've got the COVID lockdowns. They've had bank runs in China. They've had people finding their deposits converted into investment products that they can't pull out. They've got mortgage strikes at the moment. So now there's a debate in China as to whether there are going to be financial implications for the financial system, not just for the construction sector, which is way off. And, the construction sector is a huge proportion of the Chinese economy. So it's very interesting just watching them going one way while the rest of the world's going somewhere else.
Yeah, that construction one was the one I was going to mention, some of those numbers that are coming out that they'll have to government start buying everything, and not unlike what we saw in the US during the financial crisis. They're buying mortgage-backed securities and that kind of thing.
Well, yeah, and there's a big debate about how the money goes around, because basically local authorities give the money to the developers and pass it on to the banks, and the banks then pass it back to this big sort of scramble, and it goes. This is all GFC type stuff again. Nobody quite knows what the counterparty risks actually are anywhere in the system, and that's why I think, to my mind, things are going to get worse in China ahead, and that's really important for us because, of course, 37% of our exports go to China. I think it is. It's a big number. LNG being the most significant one, but steel and coal still there as well. So if China catches a cold, then we could get the flu.
All right, so this is the official cash rate as of today, and the bond market or futures implied curve.
So this is the Australian one. The cash rate at the moment is just under 1.4, 1.35. And interestingly, even now the bond market and futures market is saying, well, we're going to go up, into February, March, and maybe a high of 3.35, 3.36, 3.37, but then we're going to come back down again. So by the end of December 23, we're going to be down to 3.1, so up and then down. And if you compare that with a few months ago when it was going to be up, it's definitely bringing it in. So interestingly, of course, the RBA has said, no, we'll probably won't need to go as high as that, and other people don't necessarily agree, but that's what the market is saying. And interestingly, if you look at what actually happened and what the market thought was going to happen, they've been spot on at this point. The RBA has been completely away from where they should be. So it'll be interesting to see. Will they do 50? Probably next week, and a bit more ahead according to the market. So that's going to put huge pressure on households.
Yeah. You got some good charts here on the repayment increases for different types of loans.
Yeah, so this is from Michelle Bullock's presentation from the RBA the other day, and it's worth just noting that for the variable rate loans, there's at least 30% of households who are going to face repayments of 40%, right? And there's more with 30 to 40% more. So there's a lot of people who are going to see really, 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 really large increases. I'm sure there are some that don't have an issue. And if you look at fixed loans, a lot of fixed loans are also going through the roof as well. And they've got a bit of a distribution there. So it's not going to happen immediately, but it will happen through the next 12 to 18 months or so. And some of those are, again, 40 to 60% higher in terms of the repayments. I mean, these are big moves. So the question is, how many households are going to get caught in this pincer movement of higher rates? And the answer is more than a lot of people would want to recognize. And, everyone's been trotting out the $250 billion of buffers, right? But that's, of course, for everybody. That isn't across mortgaged households necessarily. And in fact, within the mortgaged pool of households, about a third have no buffers at all. And a lot of those are the ones that are going to be caught with this. So that's why this is a significant crisis ahead.
Yeah, and once again, just to reiterate for people at home, we've got the change in dollar value of the monthly payments. And even if some people do have that buffer, it has to come from elsewhere. People aren't going to go spending on restaurants or other leisurely activities, goods and services.
It's going to reduce activity, and that's the point. So just as in the US, retail's down, well, retail is going to go down here. And whilst retail was a bit stronger this time, actually, relatively, it was quite weak. And in fact, it was more about you having to pay more for the same stuff rather than buying new stuff. So,
yeah. And here you've got some of those repayment buffers that you're talking about. So, as we said, some people are ahead, but there's a lot that aren't as well.
And this is looking, if you look at the Westpac data, right? So they're saying that if you add the, less than a month on time and behind, nearly half of their book is actually close to the wind, which is what my surveys show. And Westpac said that. CBA also said we've got 36% less than a month. So these are large numbers of households with very little wriggle room. And if you look at that, my mortgage stress, which is the next chart there, what you can see is that this is a big deal. A lot of people are really in difficulty. And in fact, the latest stress, 45% of households have cash flow problems with their mortgage at the moment. That means that they can probably still pay their mortgages, but they're doing it by cutting back, just not spending things on other areas. And that's also rental stress has got up too. So the point I want to make is I've been plotting this chart for some time. I've been talking about the number of households in difficulty. And now official data from the RBA and data from Westpac and CBA are actually in line with my modelling. And that's a very significant fact because until quite recently, everyone was saying, well, you're off on a different planet. That's nothing like reality. Well, actually, yes, it is. It's been like that for some time. And now everybody's finally waking up to it.
Well done, Martin. All that hard work's paying off. Like I said, all the media want you at the moment, but hopefully the audience has been watching you for a long time and they're a bit more prepared than everyone else.
I hope they are. And I keep saying to people, look, you can't rely on the government to get you out of this. You need to actually build a cash flow for your household. Make sure you've got the cheapest mortgage you can get. Be careful with debt because if you've got high interest debt, that's a real problem. So the things you can do, but it is going to be tricky for a lot of people. And, 45% of households in stress, that's 1.6 million households, are finding it difficult now to make ends meet. More rate rises are coming. So prepare now.
Yeah, I guess just financial literacy in general, which is what we both try and do, and just help people understand what's going on. That's probably one of the best things you can do to get yourself ahead compared to everyone else. So, yeah, absolutely
right. Yes, I think financial literacy is a really big issue, and that's one of the reasons why I'm here and you're here.
Awesome. Okay. APRA's warned the government about these heightened risks from interest rate rises, but I guess...
funny that.
Yeah, isn't their whole job to make sure that we can, all borrowers can withstand these increases? But anyway.
This is really... This was a 46-page FOI the AFR actually made, and it showed that in May, APRA sent a report to Albanese saying there are some risks in the system, particularly around housing risks, as interest rate rise, and the financial stability is probably okay, but there are some factors here that are worth thinking about. I'm surprised that publicly they've hardly said anything, but privately they've been talking now to the government about risks in the system. So again, all these stars are aligning, right? The mortgage stress, the banks buffers, the RBA, and even APRA. Now, my argument is, well, hang on, I thought APRA was meant to be to take some accountability for this, right? Because financial stability isn't just the banks, you got to think about households, but actually that they don't think that that's their job. So financial stability of households is not anybody's responsibility. There's nobody taking responsibility for that in the regulatory system. That's a real problem. And of course, Wayne Byres is now leaving in October. So he had a longer contract, but he's leaving. So the guy in charge of APRA is now walking away. So I'm afraid accountability doesn't sound to me as though it's going to stick with him.
We try to stay politically neutral on the channel as well, Martin. It was interesting you just mentioned the letter that has been sent, and we have seen the media in recent months, Albo come out and talk about directly to the RBA and sort of pushing it back on them. Hey, we're just in government, and we've also seen the Treasurer speak about that, and we've seen is it Royal Commission or the investigation? They're actually going to look into the actions of the RBA.
Yeah, so there's an inquiry into the RBA, but it doesn't include APRA, and there's three renowned experts looking at monetary policy, inflation targeting, all those things, the structure of the board of the RBA, etc. So that's all good, but it's necessarily not sufficient. We should be looking at the role of APRA and how that works, because APRA is part of the problem, but they've carved out APRA from the review. So that makes no sense to me.
Yes. Okie dokie. All groups CPI annual movement.
Yeah, so this is just highlighting the fact that inflation is 6.1% now. The non-discretionary is 7.6. That's even higher. That's the stuff you've got to spend. And you know and I know that those numbers are actually not fully reflecting the real cost of things, because it doesn't include housing, and rents haven't performed the way that they've suggested rents have recently. But we know that people are really up against it. And, you can look at a couple of the elements behind that. But before we do that, the trimmed mean, which is the one that the RBA looks at, right? It's above 4%. They're targeting 2 to 3%. So they've failed. They have completely failed in their mandate to manage within that target band again. And it's also worth reflecting on the fact that APRA has not really been worrying about the risks adequately. The RBA has mistargeted inflation, and wages growth has been massively misforecast for years and years and years. So, almost all the parameters of the economy, they're all over the place.
The name escapes me of the famous, is it US economist that came out and said we don't, or he doesn't understand inflation as well as he should have just recently. It might come to me. Do you know the guy I'm talking about? Someone will remind us in the comments. But this chart, I think, shows how quickly we go from 1% to 6% when people were saying, well, hold on, if you print all this money and you hand out all these, is that going to cause inflation? It's like, no. And now these experts are coming out and saying, we're starting to understand how little we understand about inflation.
And there was a very, very good paper that was released in New Zealand this last week, which was trying to say what's caused it. And it's very interesting because, of course, the official story is that it's all to do with Ukraine and oil and supply chain disruption. But their paper said, no, a lot of this has been caused by central banks themselves, by the cutting of interest rates and by the quantitative easing, which you and I have been preaching for some time, right? They are responsible for a lot of this inflation. And it's very interesting how even now they keep saying, no, nothing to do with us. It's over there. It's it's international problems. No, you created this problem.
I think it was Paul Krugman, but let me know down in the comments. Yeah. Okie doke. Next up, we've got new dwelling purchase by owner-occupiers.
This is just two elements within the inflation. So the new dwellings element shot through the roof, right? So construction costs are way higher, costs of materials and labour, massive. And the other is the automotive fuel, high again. I remember the 23 cents comes off in September, or 22 cents, whatever it is. That's not going to be continued. So we already know that there's more high inflation. We know that there's more costs coming from construction. And let me say again, the true costs of housing are not in the inflation numbers. Yeah. That was a deliberate policy that the RBA put because they didn't want interest rates and the inflation rate to sort of get into a dance of perpetual momentum, right? Because, of course, if you have it in there, it's such a large element. So that's nuts. We should have housing costs properly in the inflation number. Some other countries do, but we don't.
Yeah. I think we'll continue. We may even see the petrol excise extended, that discount, or either way, one of my sort of thesis is that we are going to see all types of universal basic income but dressed up as, again, this isn't universal basic income, but we're going to give you these stimulus checks, but this time it can only be spent on food, or it's going to be, discounted this, that, or the other.
It's going to be very difficult to do that, Alex, because they've run out of runway. They've got $1 trillion of debt. The interest rate on that debt's going through the roof. The previous government, well, they spent a lot, not necessarily in the right places. So the question is, and the Treasurer said this last 24 hours, well, we don't have much wriggle room. So how much will they do is the question. And I guess that's a question of, well, how high will rates go? Will they come down quickly? Will wages grow or not? But there are lots of people doing it really, really tough now. And I don't think that many people in positions of responsibility understand just how severe the financial pressures are on the number of ordinary households and businesses across Australia at the moment. I see it in my surveys dramatically. Yeah. They will have to do more. And as you say, then how do they do it? And postscript, does that lead us then to the central bank digital currency as a way of getting money into people's accounts that can be controlled? Got to watch that.
Yes, I agree with that. And I don't necessarily think it's the right thing to do. I just think it is something that they're probably going to do because of how political it will become.
Yep. Yeah, I agree. And because of all that, consumer confidence is still very, very low. Okay, it moved up slightly, but the inflation expectations are a bit stronger again. But look, this is as bad as it was, around the COVID. And interestingly, consumer confidence is weak, not just here, but in pretty much all Western countries too. So that tells you that consumers know that things are not right and that their ability to spend is very much curtailed. All those things are in play at the moment. So That's why this is an important number.
Yeah. Wow, nearly 19,000 properties for sale in the Sydney region.
Yeah, and this is from Edwin. I do a show with him on Monday, and there are more listings than ever, which is weird at this time of year. Normally what you find is listings drop through the floor, but no. This year, there are lots of listings. A lot of people being forced to sell, a lot of people choosing to sell their investment property before prices fall. And that's one of the reasons why house prices are sliding and quite quickly. And listings now are growing in quite a lot of other areas too, although Sydney's leading the way. And in fact, if you look at the next chart, you can see there that we've got some information there about house price falls. And you can see there that North Sydney and Hornsby down 8.4% over the quarter. And now that's a year-on-year growth of just 0.7%. If you look at the Northern Beaches in New South Wales, down 6.8%. And that actually is below a year ago. So a lot of that froth is now being boiled away in some areas. It's not true up in Brisbane yet, but we're starting to see negatives and quite strong negatives. And, the rate of change of house prices down is accelerating. So my suspicion is we're going to see quite significant falls ahead.
Martin, I think I saw on Twitter somewhere as well the percent of auctions or just sales in general that have been reported. Is it historic lows as well?
Yeah, so the numbers of listings are very high. The number going to auction is down a bit, but the clearance rates are very, very low at the moment at auction. And more people are choosing not to go to auction because it costs more than not. But also, it's just the case that there are less buyers in the market at the moment. And I've attended a few auctions locally around here that have been cancelled on the day simply because there was nobody there who wanted to buy. So, yeah, I think that, the property market is in for a very significant wobble. The question is, how long will the wobble go on for? If rates start to come down again, if migration is significantly ratcheted up, which they're talking about, well, maybe it'll turn around again. And the other point, of course, is with the issue with regard to the US and China and Taiwan, all those things, and some of those international crises that are going on, Australia starts to look a very, very nice place to come and live. So I wouldn't be surprised to see a bit of a change in the trajectory of the property market as more migrants choose to come and live in Australia, simply because at the moment we are a lot better than many other places around the world. And, I think we're very fortunate, and we shouldn't, be so negative relative to the rest of the world about what's going on here. But there are some very issues here, but nevertheless, relatively, we're actually doing quite well. So it's all about, comparative. But I have a feeling property prices will come down. And then the question is, how quickly will they go sideways or up? The government will be very keen not to allow prices to drop too much. The RBA will be in a similar vein, but then it comes back to how high do interest rates need to go to quash inflation? And is inflation killing the critical thing to do? That's the real unknown question.
Yeah, and immigration's obviously been very low relative over the past couple of years, and so that is one of
Yep.
the things that can increase that demand pretty
They're,
quickly.
they're talking about skilled migration increasing, to bring people in, and that could help. But we have 1 million plus spare properties according to the recent census, and we have another 250,000 being built at the moment. So we've got a lot of spare properties around the place, and if investors don't see any capital growth in their property, they're going to sell.
I heard a crazy stat the other day that Tasmania has the highest rate of vacant properties.
Yep,
Yeah.
it does, and it's also got the highest mortgage stress.
Is it 10 or 12% or something like that? That's
Big
very
number.
high. Yeah.
Now that's partly because there's quite a few holiday homes there,
Yeah. Yeah.
right? Because they're included, but also a lot of Airbnbs.
Yes. Yeah. Shortage of hotels, so lots of Airbnbs. Yeah.
Correct. Lots of Airbnbs, and there's a big debate to be had about whether Airbnbs are actually part of the problem rather than part of the solution. Because I think what it does, it displaces longer-term renters. And around the time of COVID, we saw a lot of people give up on Airbnbs and let their property out over a longer period.
Yeah.
Once that went away again, they got kicked out, and now they're back on Airbnb because they make more money from Airbnb.
Yes.
That doesn't necessarily mean that feels to me like a distortion.
Yeah. Yeah. Okay. Australia's debt markets.
Yeah, and so just to finish off, I thought I'd just come back. The financial markets are creaking, right? And give you an example. In Australia, the amount of debt that's out there, government debt's very high, but the buying and selling and the liquidity is very low, and the volatility is very high. These markets are now getting very twitchy, right? And if you go on to the next chart, the corporate bond market distress index in the US, which is another way of saying, well, what's going on and what is the amount of problem, is going up. So what we're starting to see is that areas within the financial markets are getting stressed. Now, think back to Fed 2 or 3 years ago when they started lifting rates. What caused them ultimately to turn turtle? It was actually the financial markets, and the financial markets beginning to wobble. There are some early signs here that the financial markets are now beginning to wobble again. And if they do start to really move further in that direction, there's another reason why maybe some of the central bank rate rising will turn into rate cutting, and quite quickly, and perhaps more quickly than the markets are expecting. So worth watching those leading indicators, because I think that will tell us more about what's going to happen over the next few months than the stock market. The stock market's very bullish at the moment. Very high. Was up again today. It was up yesterday in the US, because now they're thinking we're not going to get a surprise in the next few months, right? Well, maybe, or maybe there will be more surprises. We'll see. I personally think the stock markets are still overvalued, and my view is that we're going to probably see more to the downside before they recover. And interestingly, financial markets are definitely signaling. The bond markets are definitely signaling lower rates, more difficulty ahead. So complex times.
Yeah, I think if everything was fairly valued and we had a complete reset, then you'd argue stocks are way overvalued. But I tend to fall in the camp that they're going to do everything they can to blow that bubble. And every time we see these weaknesses and wobbles, they come out, and we got the jawboning last night. Oh, we're not so sure about our full guidance anymore. And, stocks, Bitcoin, everything takes off again as soon as they hear any hint that the money taps are going to be turned back on.
Absolutely. No, it's a very important. And they all make the point. If you look at the reverse repos here on the US, right now, the central banks are paying the banks for money they're putting at the exchange settlement accounts. They actually do quite well now because the rates have moved up dramatically from where they were. Yeah. That's another sign of significant distress in the system. So wherever you look below the surface, there are significant signs of stresses and strains going on. And so things are not anywhere near as pristine and optimistic as perhaps the stock markets at the moment are realizing. And remember, the markets are still way down from where they were. But then the question is, what will they allow to break? Which bit will they allow to break, right? And is it better to have a higher level of inflation and live with that? Or is it better to actually lift unemployment and, do a bit more, lift employment, reduce unemployment, and do more stimulus and, inflate those asset bubbles some more? Well, we know what their history is.
Well, we'll be here to commentate, Martin. So, guys, the links to follow Martin on Twitter and his YouTube channel are always down below. Otherwise, thanks for your time, Martin. We'll see you again next month.
See ya.
Cool. Thanks, guys.